What is the best investing strategy to adopt? This is one of the most popular questions that resurfaces repeatedly over the years. Naturally, when we use the term best in this context, we are essentially talking about the portfolio's performance and the returns from a logical perspective. We are not focusing on the one that is just simplest to execute or demands the least immediate time and effort. It is essential to grasp that there isn't a single stock market investing strategy that consistently outperforms all others. Various strategies function diversely depending on the market situation. So in this video, I'll delve into the array of investment strategies that retail investors commonly employ. I understand that some of you may strongly believe in specific strategies. However, to make this video more balanced and constructive, I'll cover both the advantages and the disadvantages, including aspects where the strategies that we personally employ might not fare as effectively. Broadly speaking, we can categorize the strategies into two categories: strategies that guide us on when to buy a stock or ETF, and strategies that guide us on what investment to buy. So let's kick things off with the strategy that is most recognizable to many of us: dollar cost averaging. This strategy involves investing a fixed amount of money at regular time intervals, regardless of the market conditions. Whether we are in a severe crash or whether the markets are at an all-time high, we continue to invest into the markets without question. This approach is supposed to help investors take their emotions out of the picture by sticking to a fixed time interval to invest. All sounds perfect in theory, but in practice, this strategy may or it may not work. First reason is because DCA requires an underlying instrument that has a general upward trend, so that your portfolio value eventually will be somewhat higher than the previous purchase levels. We have shared before that many investors have performed badly with DCA because they were investing into cyclical stocks or into unsound stocks that perform badly over time without a nice price uptrend. Secondly, even if you DCA into an ETF or stock that's poised to go up over the long term, like for example the S&P 500, investors may not necessarily do well because some find it challenging to stay the course. It is easy to DCA when the market is heading upwards, but when the market eventually crashes with your investment portfolio declining in value, it becomes psychologically difficult for some investors to continue to pump in their money. So this makes DCA less easily executable and may not necessarily take the emotions out of the picture. But even if we can take such behavioral biases out of the picture, the essence of DCA simply assumes that market timing is futile. This is of course a sensible strategy for retail investors who know nothing about technical analysis. And the next best thing that they can do is to get invested. If the underlying stock or ETF is sound and it goes up over the long term, then a DCA investors can still do well, although it is not exactly the most risk-efficient method. Up next is value investing. Value investors only buy a stock when the current share price is below the intrinsic value of the stock. A stock's intrinsic value is computed using the discounted cash flow model, which is supposed to give us a good sense of how much a stock is potentially worth based on certain assumptions. Usually, value investors apply this on quality stocks, which overlaps with the fundamental analysis strategy that we'll touch on later on in this video. The downside of this strategy is that while the theory of DCF is sound, assumptions are involved, such as the discount rate and the future growth rate of the business. It is like, can you predict how much money you can make for the next 10 years? So these are often too many variables at play and assumptions being made where we don't even know what we don't know. So it is probably more useful for the more traditional and stable businesses where their business models are less likely to be disrupted and less useful for the tech companies, for example. Another problem is that in practice, DCF works better over the very long run where the markets follow the earnings of the company. But in the short run, the stock market is largely about emotions. Investors can still lose money while waiting for the calculations to materialize. So stocks can well stay below or above their intrinsic values for many, many years. In practice, it has been proven to be challenging for some value investors to stay in the game after they see that the stock prices haven't picked up after 3 to 5 years. Everyone thinks that they can have a long-term investing horizon, But if something doesn't work for 3 to 5 years, there is a danger that most people give up halfway. So personally, do I follow this DCF calculations? No, I don't. Personally, I feel that these calculations, while valid in theory, merely provides an illusion that things should turn out fine eventually. I prefer to be more in tune with the market's movement, understand the crowd sentiment, and look at where the prices are trending. It does not matter how good a stock is, how high its intrinsic value is, if the markets do not yet believe in it for the short to mid-term. The next common strategy that investors use to decide when to buy is macro investing. Macroeconomic investing focuses on identifying and capitalizing on broad macro trends that influence the financial markets, asset classes, and the economies. Instead of analyzing the individual stocks or companies in isolation, macro investors study the global economics and politics to make their investment decisions, such as when to buy and when to sell the stocks. It is worth noting that macro investing can be challenging and risky due to the unpredictable nature of macroeconomic events and their effects on the financial markets. So, are there people who excel at macro investing? Very far and few, while not impossible. And in a consistent manner, it's even harder. Which is why Warren Buffett, one of the greatest investors in the world, says that he approaches macro investing with a high degree of skepticism. He says that investing successfully is about looking for the pieces that are important and knowable. Even if something is important but not reliable enough to know how it will pan out, it is still useless. Another strategy on when to buy is using technical analysis. Technical analysis is the study of stock price movements, price action, candlesticks, and market indicators to anticipate possible future price movements. This strategy is more focused on the short to mid-term timeframes to invest in stocks at appropriately low prices based on the current price trend. Investors who employ this believe that asset prices tend to move in persistent trends over extended periods. For investors, it can be used as a risk management tool to time your entries, deliberately to lower your weighted average cost, or to decide when to take profits off the table. There are no emotions involved because you look for clues that the market is trying to tell you objectively. What is the drawback of this type of investing? Again, this is not 100% 包价. It's not a 100% fail-proof method. So don't buy all in at one go. Add in tranches. But the good thing is that you don't need to be correct 100% of the time to make money. One of the bigger issues with technical analysis, if you ask me, is that it is often more of an art than a science. You throw in the same charts to 10 investors that claim to do TA, and you can have half of them being bullish while the other half being bearish. Hence, it matters how you're able to interpret the stock charts. The fifth strategy which some investors take to determine when to buy stocks is sector rotation. This strategy involves allocating funds to sectors of the economy that are expected to perform well in the upcoming investing environment. It requires staying informed about the market cycles and adjusting your portfolio accordingly. Investors doing this strategy will tend to be underweight and overweight in certain sectors, so as to possibly bring about the greatest gains and minimum losses. It is more of getting the most bang of your buck and getting better risk-adjusted returns for the portfolio. The downside of this strategy is that because these investors shift things around more frequently, higher transaction costs are expected. But generally, if they are good with it, the capital gains can more than easily cover this cost. The last common strategy that investors take to determine when to buy a stock is contrarian investing. Contrarian investors will go against the prevailing market sentiment. They can be on the sidelines for a long period of time, for months or for years, and they try to go in big when others are selling desperately. This can also be called crash investing, where these contrarian investors only buy when there is blood on the streets. For the most part, they usually have a lower average cost compared to someone who simply dollar cost average, because they are more selective in timing their purchases. The good thing about such a way of investing is that normally you don't need to watch the market so much, as there will be enough alerts coming from the financial media reporting on how bleak the future will be to prompt you to start buying. The drawback is that contrarian investing without technical analysis reduces the probability of timing better to lower down your average cost during a crash. So investors may find themselves buying only in the middle of the crash and have to be underwater and see through a large part of the crash before it eventually recovers. The important thing for such a strategy is that you must only be buying the good stocks or an index ETF which will go up over the long term. Crash investing does not help for unsound companies that may no longer recover. Contrarian investing simply means that you lose less if you buy the wrong companies, but your upside is still going to be limited if you don't buy the right companies. These are some of the common strategies that investors adopt to decide when to buy. Moving on, let's now take a look at the common strategies that investors use to determine what to buy. The first strategy is index fund and ETF investing. Passive investing through index funds or exchange-traded funds involves investing in a diverse portfolio that tracks a specific market index or sector. This is good because usually an ETF or index fund will self-select the better companies in their holdings. So this strategy aims to match the performance of the overall market or sector rather than outperform it. By an ETF being an ETF, it is just like buying a basket of fruits that is already packed for you. So you might get some of the rotten ones along with it, but you can't reject those. As a result, you would have some of the poorer performing stocks putting a drag on the portfolio performance. On the other hand, some investors prefer active stock selection and adopt the strategy of quality investing or fundamental analysis. These investors aim to invest in companies that have strong financials, solid management teams, and a competitive edge, so that the companies are more likely to weather economic downturns and deliver consistent results. They do what we call fundamental analysis and study the financial statements of the companies. Hence, even if they did not purchase the stock at the best price, the sound fundamentals would likely bring about stock price appreciation over the long term and make a profit. The third strategy that investors commonly adopt on what to buy is growth investing. Growth investors focus on companies that are expected to experience above average earnings growth. They are willing to pay a premium for stocks with the potential for significant future expansion, even if the current valuation might be high. On the downside, a growth investor must be ready to accept greater volatility to their portfolio. These stocks often have a higher beta, which means that if the market falls by 1%, theoretically, the stocks may fall by more than just 1%. So a growth investor must also be careful not to buy growth stocks that have been too hyped up or out of touch with their valuations. The last strategy is dividend investing. From a poll that we did earlier, it seems that most Singaporean investors are actually dividend seekers. Dividend investors invest in stocks of companies that regularly distribute dividends to generate a steady stream of passive income. If you have a sizable sum of money, like say $2 million, then at 5% dividend yield, you can receive 100k of passive income a year. Hence, it may not matter to you whether the stock price goes up or goes down. It can feel like having a machine that prints money every quarterly or every half yearly. But a word of caution, even though dividend investors largely focus on the dividends received, at some point in time, some of them may need to liquidate their investments. Hence, the price that they buy and sell their investments at, in other words, the capital gains or losses, matter as well. Just ask dividend investors who had invested in SPH, Singtel, or ComfortDelGro. If you buy the wrong stock or the right stock at the wrong price, dividends collected may not be sufficient to cover the capital losses. At this point, I've covered a comprehensive overview of the investment strategies that are commonly employed by investors. Now, you might be wondering, which approach does the joyful investors adopt? No, the answer is not just one single strategy, but a blend of strategies. In particular, fundamental analysis, technical analysis, contrarian investing, and sector rotation for both our growth and dividend portfolios. And we coined our unique investment methodology as Moneyball Investing. While the term Moneyball itself isn't an original creation, the intricacy of our approach are entirely of our own making. It takes its inspiration from the concept of Moneyball in sports, particularly baseball. The term Moneyball originated from Michael Lewis' book, Moneyball, The Art of Winning an Unfair Game, which discusses how the Auckland Athletics baseball team used data analysis and statistical methods to identify undervalued players and build a competitive team on a limited budget. In the context of investing, the Moneyball methodology applies similar principles to identify undervalued or overlooked investments in the financial markets. So similar to how the Auckland Athletics use statistical analysis to identify undervalued players, Moneyball investors rely on technical analysis and fundamental metrics to uncover companies with quality performance, but the market is undervaluing them currently. So the Moneyball methodology acknowledges that the market inefficiencies can arise due to investor behavior and biases. So by capitalizing on these inefficiencies, investors can then identify opportunities that are not fully reflected in the market prices yet. Just like value investing, Moneyball investing can have a long-term perspective, and we are willing to hold on to the undervalued assets until the market recognizes their true value. However, there exist significant distinctions between Moneyball investing and the conventional value investing. For value investors, the margin of safety is primarily rooted in buying stocks below their intrinsic value. In contrast, the margin of safety for Moneyball investing comes from buying stocks at support levels by analyzing the stock price movement. The reason is that stock price movements represent a collective manifestation of the sentiments of the market participants, whether they are more bullish or bearish. For example, stock market recovery happens when there is a shift in the collective market psychology, and most investors have capitulated with no more sellers left, which we can observe through the stock chart analysis. And finally, Moneyball investing dictates that we are more selective in our investment choices. We usually do not buy index ETFs, but instead we will carefully evaluate and invest in only a handful of stock opportunities, which are more likely to do well. The exception would be during market crashes, where almost all stocks are at low valuations. Then buying an index ETF is just as sensible. And as the stock prices rally up, some ongoing positions may become less appealing over time. And that is when we may then trim off some of these positions to recycle the capital into other stocks with better ongoing risk to reward opportunities. So in short, our Moneyball approach of investing at the Joyful Investors aims to capitalize on opportunities to invest in good stocks at good prices due to the market inefficiencies and the behavioral biases. So the use of historical data, statistical analysis, and probabilities increases the chances of achieving an asymmetric payoff profile. As I've mentioned at the start of the video, there is no perfect strategy that has no limitations at all. So as technical analysis plays a significant component of our Moneyball investing, while it can yield a high success rate, it is not 100% fail-proof. To give an example, during a market pullback, we may have added positions of a stock at an identified support level, but the stock price continues to decline after we bought. So to address this, employing risk management techniques such as proper position sizing, buying in stages instead of one lump sum, and occasional option strategies can play a pivotal role in managing the potential losses. So over time, prices should gradually recover, especially given that our focus is on fundamentally strong companies. So we have covered the various strategies that are commonly employed by investors, their respective advantages and downsides, as well as which ones we personally employ ourselves. In the second part of the video, I will share with you the thought process on how you can identify the investing strategies that are appropriate for your investments.